Welcome to the More Time, More Money and More Wealth mini podcast for medical professionals, brought to you by MediSuccess and the WOW Advisors Group. This podcast is dedicated to medical professionals who would like to work smarter, not harder, earn significantly more income and create astonishing wealth. Now, let me introduce you to our host today, Hitesh Mohanlal.
Hello and welcome to the More Time, More Money, More Wealth podcast for savvy medical professionals. And today I want to talk about something that you have probably been talking about amongst your peers and colleagues, and that is the new 3 million tax rules for superannuation. And I can tell you upfront that it is pretty nasty. All right. So I know you guys have been discussing it amongst yourselves, and there's a lot of stuff happening in medical forums as well. So really the question is, should you be panicking? Should you be selling? Should you be investing in super? Or are you just going to be grim and just pay out? The honest answer is I don't really know, but I'm going to explain to you what it means and what you need to think about. All right. So firstly, there's an awful lot of misinformation out there about this tax, and this tax is known as Division 296 tax, and most of the stuff you've been hearing and most of the misinformation you're getting is a bit scary, and so there's a lot of confusion out there as to what does this all really mean. All right, so if you speak to some, it's like, oh my god, the world is ending, and they're running around screaming and all hell has broken loose. Others are just going to be more polite and say, look, this is going to add costs, it's more burdensome, and we're just going to have to deal with it. If you ask me what I think, I'm going to tell you right now, I think this tax is bonkers. All right, it's nuts and it's stupid, but it's here and we've got to deal with it. All right, so you do need to know what it means for you. And if you have significant amounts in your super, or you plan to invest significantly in super, you must, and I repeat this, you must review your position. And to be quite honest, everybody needs to review this. It's not just those that are wealthy, all right? Because this is one of those areas, and you hear it all the time, make a decision based on your personal circumstances. This one is one of those. You really, really need to look at personal circumstances to work out what you need to do. And I don't care if you're a medical professional or you're a brand new, fresh graduate out of university on a salary of, say, 60 grand. The reason is because your kids are actually going to get more affected than maybe you are. All right, and I'll explain a little bit about that later. All right, but first of all, let me kind of knock out this misinformation we got flying around. Okay, so number one, the $3 million cap relates to individuals, which means each person has a $3 million cap. That means if you're a couple and you've invested pretty much equally into your super between yourselves, your combined investment can be as high as $6 million before any Division 296 taxes are paid. And 6 million is a pretty decent figure. All right. Number two, the super fund is not taxed. The only person that is taxed is the individual. So for example, let's say you have a self-managed super fund. In that fund, the members are your spouse, your 20-year-old child, and yourself. If your spouse has a balance over 3 million, but your child and your balance is below the 3 million, the only person who's going to be paying this tax is your spouse. Although your spouse can elect for the super fund to pay that tax. The third, many of you feel you have to act immediately. You've got to do something now. And that is simply not true. I'm not telling my clients to panic. I'm telling them to think and come up with a plan. Yes, the rules are probably going to come into play from the 1st of July. And to be quite honest, the legislation has not been passed yet. But if there are any taxes to be paid, they're going to be paid based on the superannuation balance at 30th of June 2026. So you've probably got about 12 months to work out what you want to do. And finally, number 4, per the government, and of course we always trust what our government says, right? They say that there's only about 80,000 people, or about 0.5, so 0.5% of super balances that currently exceed the $3 million. So really, it's not going to affect many people. And I'm going to tell you that is crap and not true, okay? Because it might not affect many people right now, but as time goes and as years go by, you're going to see more and more and more people get caught up into this. And I'll explain that a bit later too. All right. So in simple form, this is how it works, okay? At 1st of July 2025, you have a super fund balance of, say, 3 million. At 30th of June 2026, 12 months later, the balance is now 3.2 million. In a nutshell, you pay 15% on the additional $200,000 your fund has grown. But remember, we're dealing with a bureaucracy, and when you're dealing with bureaucracy, it is not that simple. And to be quite honest, accountants like me who are looking at this really are upset and do not like this at all, to the point we want to actually slash our wrists, okay? I honestly don't want any client of mine going above the $3 million cap unless it makes tax or wealth sense to do so. So you really got to think about this. The calculations that we have to do are not as simple. This is because it's not as simple as looking at the balance at the beginning and the balance at the end. We as accountants have to calculate something called the adjusted super balance. And to be quite honest, it's a pain in the backside. And the thing is, it's got to be done every single year if you have a balance in excess of 3 million. Now, I'm going to give you an example and a calculation, all right? And the calculation is based on 5 steps, okay? So let's take a doctor, Dr. Adam. He's 50 years old, and his entire balance is in what's known as the accumulation phase. That means he hasn't retired and he doesn't meet the criteria for making withdrawals from his super fund, all right? He has a balance at 30th of June 2026 of $12 million, and his super balance as at 30th of June 2025, i.e. 12 months before, of 11.5 million. Now, during 2025-26, he obviously hasn't received a pension because he's not entitled to one, but he has made concessional contributions into his fund of $20,000. All right. So, as I said, there's 5 steps. So the first step we have to work out is Dr. Adam subject to this tax? Okay, and the answer is yes. And then the reason is because his super balance at 30th of June 2026 is more than 3 million, and his super balance as at 30th of June 2026, after taking into consideration his withdrawals and contributions and less of his super balance at 30th of June 25, is greater than 0. All right. So now, step 2, there's actually a formula, okay? And it goes like this. You take the $12 million super fund balance, okay? Then you add on to that any pension payments made, which in this case is 0, okay? Then you minus $17,000 contribution. Now, I know I told you before that the contribution was $20,000, but that is before any tax effect. Once you take out the tax effect, the actual amount is $17,000. So we take 12 million, take away 17,000, and then we take away the 11,500,000 super balance, which was there the year before, okay? And what you get is a balance of 483,000. Okay, so park that figure of 483 on the side. Step 3 is we've got to look at any losses. Now, there are no losses in this particular year, and the way you create a loss is if your super fund balance at the end of the year is less than the balance at the beginning of the year, you've made a loss. Okay, and you can take that loss into consideration. All right, so we've got to take away any losses. But in this case, we've got no losses, and because it's the first year of this tax, there will be no losses that can be used. Step 4, we've now got to work out a percentage of Dr. Adams' super that is to be taxed. Okay, so we've got to do another formula and another calculation. So we take the $12 million that the super fund is now worth, we take away the $3 million cap, and that you're left with $9 million. Okay, you then take the $9 million and divide that by $12 million, and you get a percentage, and the percentage is 75%. And what you then do is you say, you take 75%, multiply that by 483, which was a calculation that we did before, 483,000, and you multiply that by 15%, which is the tax rate, and you come out with a whopping figure of 54,337. Okay, and that's why if you've got large balances, or you want to build large balances, you've really got to speak to somebody. All right, there's more. You do not need to be a nuclear scientist to work out that your accountant and your auditor is going to increase their fees for dealing with this extra rubbish. Okay, so you're going to end up paying your accountant to work out how much extra tax you're going to pay, and to me that's just insane. Okay, all right, now here's why this tax is particularly nasty. This must be one of what I call the stupidest taxes ever imposed on Australians. Okay, it's probably on par with payroll tax, to be honest. Okay, but there are particular reasons why I think this is very nasty. Okay, number one, the $3 million cap isn't indexed. Okay, so we all know, right, that if we spend $10 now, what we're going to get. And we also know that if in the future we spend, or we want to buy the same item, it's going to cost more because of inflation and cost rises and all the rest. Okay, so if you plug the figures in ChatGPT, if you spend $10 now, it estimates that in 20 years time it will be worth $18. All right, okay, and that's just based on an inflation rate of just 3%. So you'd think Sir Albo and Sir Chalmers are intelligent enough to know that what happens in future you're going to need more money for, right? But it doesn't feel as if they understand this, because what they've said is this $3 million cap is never ever going to go up, which means it's going to catch more and more people. All right, and I think that our children are all going to get caught up. Okay, again, I've used ChatGPT, and I took a brand new graduate at the age of 25 earning $60,000 a year, and they have wage increases of just 5% for the next 40 years, and I have assumed his superannuation is going to be growing at 7%. According to ChatGPT, he will end up paying Division 296 taxes. All right, so this tax is actually insane, because at some stage it's going to catch literally everybody. All right, 2, your cash flow is going to get hammered. You want to know why, again, this is a stupid tax? It's because everything we know in the Western world about capital gains, it flips on its head. Okay, Australia will be the first country that's going to tax assets that have not been sold or realized, and that is going to cause us real cash flow problems. So let's just take Dr. Adams' example again. Let's assume in his self-managed super fund, he's got property and a share portfolio, okay? And during the year, as I said, his value, or his super fund, has gone up by $500,000, but he hasn't sold anything, all right? His bank account hasn't changed, but he's still got to find $54,000 to pay a tax when he's actually not received any money. Where is that money going to come from? And to me, if that's not bonkers, nuts and stupid, I don't really know what is. Okay. Number 3, Division 293 taxes still need to be paid. So most of my clients, most medical professionals I know, earn more than $250,000. And so you all know that you have to pay an additional 15% on your super contributions. That doesn't change. You still have to do that. Okay. And now you've got to pay this additional one too. And most people will get their super funds to pay it. If you haven't cashed in investments within your super fund, how is the super fund going to be able to pay this? And that's why I think it's going to cause all kinds of problems from a cash flow perspective. Number 4, retirement planning is long term. Okay, so decisions regarding super are made on a long-term basis. I never sit down with a client and talk about super and say, well, you know what, in 5 years' time, this is what it's going to be. It's always, we're going to take this till you retire. Okay, and once money is in super, there's not an awful lot you can do about it. Now, governments are now looking at super and they think this is a bit of a cash cow, let's milk it. Okay, they keep changing the rules, and this plays havoc when it comes to retirement planning, because it's really hard to plan because you just don't know what the government's going to do going forward. Okay, so decisions that are made by you and me many years ago based on tax rules which were favorable are now all of a sudden not favorable, and there's not an awful lot that we can do about it. And I have a particular pang about that. I think that's grossly unfair. Okay, number 5, estate planning. For many of our super funds, we think of them as not just being our retirement fund, but also if we die, then those funds are going to get transferred to our loved ones. Okay, so if we have super fund balance and we're paying crap load of taxes out of this, then it means that there's less in the fund that are going to be left behind for our kids. And estate planning now is something that we need to consider as to whether that is effective or not. Okay, going forward, what should you do? Honestly, I'd really like to tell you, but I don't think I can. And that's because the tax, or this particular tax, affects people in different ways. So literally every case is different and you can't see anything in isolation. But I think there's a few things that you do need to think about. Okay, 1, actually check your super balance. I know this sounds obviously, but most people actually don't know what their super balances are, because once you've worked that out, what you've got to do is work with your advisor and accountant and work out what you think your future balances are going to be and if it's going to be impacted by this new tax. Okay, number 2, your investment strategy may need to change. Okay, so you probably need to look at where you're holding assets, particularly high growth or speculative assets. Okay, shares, property. Think about where you're going to hold particularly volatile assets. Crypto is a classic example. If you've got that sitting in super and it has a massive spike one year and it drops the next year, it's going to cause havoc to all these calculations. Okay. And you might find that once you speak to your accountant and your advisor that, you know what, holding assets in, say, family trusts or different portfolios or different investment vehicles might be better for you. Okay. 3, plan your cash flow and start now. Okay. In most cases, the taxes will be payable even when assets have not been sold. Okay. And you've got to work out how you're going to plan making those payments. Okay. The Division 296 is a personal tax. It can be paid personally, or you can ask the super fund to pay it. Whichever way it goes, you've got to kind of work out how you're going to fund it, especially if most of your assets are sitting as real estate and you need to cash them in. Number 4, review your estate plan. Okay, as I mentioned before, most of us see it as an inheritance that we may leave to loved ones. That may need to change. Again, you might need to think about transferring assets into family trusts and then passing that on. Number 5, consider selling assets. Do not do this without speaking to a professional first. Okay. If you are eligible to withdraw funds from super and you are close to the 3 million threshold, you may consider selling assets in super and then withdrawing that amount and investing that elsewhere if it is tax efficient to do so. And remember, you don't have to do it now. You've got some time. The critical date is 30th of June 2026. But, and I want to reiterate this, Please, please, please be careful. Do not assume that by doing any of these things, taxes will be saved. So you've got to speak to a professional. You've got to do some calculations before you do anything. All right. You could potentially increase the amount of contributions you put into this year to 30th of June 2025 to maximize it, and so it doesn't get caught in future years. Personal decision. I don't think it's going to make that much of a difference, but it can. And finally, I will say to you, seek professional advice. And I cannot stress this enough. If you have a cancer, you go and see an oncologist. You don't go to a neurologist. Okay? This is going to be the same for your financial well-being. Work with a financial advisor and an accountant who understands the complexities of superannuation and are able to create a tailored plan for you. They can model scenarios, they can help you decide and rebalance portfolios and help you explore other ways of doing the same investment. If you go to the wrong person and get the wrong advice, it can become a very, very costly mistake. Finally, Hitesh Mahanlal, i.e. me, and MediSuccess are not licensed financial advisors or planners. Okay, the information in this podcast relates to the effects of taxation and is general in nature. When investing, taxation is only one aspect that must be considered, and you should and must speak to a licensed financial planner before taking any action. Hitesh Mahanlal, as in myself, and MediSuccess cannot be responsible for any action as a result of this podcast. Thank you. I hope that was useful and look forward to seeing you on the next podcast.